we've got a super panel here. Rick Graf, who's President and CEO of Pinnacle, Jean Costello, who's Senior Vice President for Real Capital Analytics, Bert Hoek, who's a Senior Portfolio Manager for North America for Bouwinvest, and Amy Erixon, who's a Principal and President of Global Investment Management at Avison Young. Let's just start with some introductions. Maybe let's just start with you, Amy. Just spend kind of 30 seconds, a minute on who you are and what you do.
Sure. Well, Avison Young is a Canadian-based global full-service real estate company, and I lead the investment management practice, which is active in Canada, the United States, Mexico, in Germany, and we're right now working on entering the UK market. So we leverage the platform on the ground in all of these markets. We have about 5,000 real estate executives, and we're growing rapidly. So that's my 2 cents.
Super. Thanks very much. Rick.
Yes, welcome. Thanks for having me. I'm Rick Graf, the CEO of Pinnacle. Pinnacle is a US-based multifamily property management investment company. Earlier this year, we became part of the Cushman & Wakefield global network with a transaction that occurred in March of this year. And we manage multifamily properties throughout the United States and Canada, roughly 175,000 apartments at this point in time.
Super. Thanks very much. Bert.
Yes, thanks, Richard. And I'm Bert Hoek. I'm leading the charge on the North American markets for Bouwinvest. Bouwinvest manages real estate investments on behalf of the construction pension fund based in the Netherlands. As a construction pension fund, their allocation to real estate is quite high and has always been the case. So we have about 60 billion of AUM, of which 20% is allocated to real estate globally.
Super. Thanks very much. Jim.
Thank you, Richard. I'm Jim Costello. I'm an economist with Real Capital Analytics. My job is to take a look at the numbers and trends and help tell stories around it. I'm living La Vida COVID here in downtown Brooklyn in New York, just isolating and waiting for everything to change.
Super, thanks. Let's start with that, Jim. I mean, just in terms of picking up on some of the key trends for cross-border investors, and let's look a little bit at Europe into US and I guess also just US coming into Europe and globally. What are the key trends that you're seeing? It's obviously been a strange kind of 7 months, but how do you see the market from a kind of US perspective?
It's tricky because there's sort of an instinctive reaction that people have that, well, if there's COVID and all these challenges, and cross-border investors should be fearful of going someplace else, investing in someplace like the U.S., especially given how much more difficulty the U.S. has had in terms of responding and dealing with the crisis in some other countries. That said, you look at the numbers and it's down, but it's not like it's down at a different pace than the numbers of investment volume by cross-border investors in the United States. Not down at a different rate than domestic investors, really. It's down overall. It's just hard to get any deals done since March with everybody kind of locked up in their homes. So it's a challenge that anybody has to underwrite and acquire properties in this time period. Activity of cross-border buyers into the United States is down, but it's not much different than everybody else.
Okay, good. And Amy, obviously based out of Canada, just how do you, for those in Europe who may see North America as one area, I guess just let us know a little bit more about the comparative differences between the US and the Canadian markets.
Well, the Canadian market is better capitalized across the board. More concentration of capital in fewer banking hands, so they have more market strength. And the pensions have much higher allocations to real estate than their US and European counterparts. Like the largest all are at 25 or 30% as opposed to say 12 or 10 or even 8 for a typical US pension. So they constitute a much higher percentage of the Class A ownership profile, probably about 2/3 of it. And it makes Canada a more challenging market for international investors to access because the domestic capital is also very long-term oriented and they're redeveloping older assets as opposed to putting them in the market. And they're also very active developers. So I'd say that's the biggest distinction. At this point in time, I think that the two markets are trending pretty comparably. The housing and industrial markets are extraordinarily strong, particularly in Canada, but in both countries. And because of the general uncertainty about the duration of the difficulties in retail and how this will manifest in terms of office on a go-forward basis, and obviously a flat line in the hotel sector, I think that the volume trends that Jim just spoke about are very similar in the two countries. We're also seeing an east-west phenomenon, at least in Canada, that's very strongly. Transaction volumes in Vancouver have been off the charts. And a lot of that is, of course, Hong Kong money coming in, as it always does at this point in the cycle. And so our apartment team, for example, in Vancouver did over 1.8 billion of transactions just in April. So the fact that we were right in the middle of COVID basically had no impact on the velocity of money coming into that market. They're both very transparent. You can do underwritings from a distance. I know it's very challenging to try and figure out whether you can get comfortable acquiring an asset in a country that you can't travel to. So gratefully, the travel restrictions between most European nations and Canada have lifted. But for the U.S. market, it looks like that's going to be closed down for longer.
Okay, that's interesting. Really interesting also that about the activity continuing on, particularly in that residential side. Rick, obviously, Pinnacle focused on the residential side. How are you seeing the market at the moment? Are you seeing the same things that Amy's seeing?
Yeah, I would agree with her comments on the U.S. markets for sure. The investor demand is still very strong. There's still plenty of money trying to chase apartment deals. I think the desired or maybe perception that there was going to be a COVID discount, if you will, in pricing really never materialized. So I think now today we're seeing our investors and clients who are really, now that they have their footing with regard to COVID and what is delinquency going to look like, what's the impact on occupancy going to be, we're seeing many investors really ramp up. They have allocations for deployment of capital this year, and they're behind, obviously, through the mid part of the year. But we saw a big tick up in mid-July going forward in terms of activity. We gauge that on underwriting and trying to help clients and investors and partners place their capital, and the numbers are pretty strong. Our collection numbers, not just us as a company, but I think as an industry in the U.S. for sure. We're a little bit off of where we were in previous years in collections, but we certainly are way better than I thought we would be. Occupancy has held strong. We're still 94, 95% occupied. The good news is people aren't moving much, as you can imagine. So we've had pretty strong fundamentals, and I think that will continue. We think there'll be a lot of transactional activity in key markets. There are certainly some that have been impacted more than others. New York, Jim, you spoke about that in terms of being there. It's probably been our toughest market. But most of the markets we operate in are doing relatively close to normal. Leasing activity is actually ahead of where we were this time last year, which is surprising to me. Obviously, we pivoted all of our activities to a digital environment, but I think we've gotten our footing and we sort of know what the lay of the land is going forward.
No, that's interesting. I'm going to come back to you as well, Rick, on comparisons between Europe and the US, because I know the last time we were on a panel together, I think was maybe 2 or 3 years ago at Expo Real, and I dug into that and remembered what you said at that point, so I'm going to come back to that later. Good. Just coming to you, Bert, I mean, residential, big topic as well in Europe. You've just opened an office there in the US. I guess, what's driving that for you? Is that diversification? Is that because you see more opportunity in North American markets at the moment? What's the strategy, Bert?
Yeah, I think all of the above, and I'll be careful what I say now, Richard. You'll be taking notes 2 years hence. Yeah, we just issued the press release last week that about the opening of the New York office. It's not the first office we opening internationally. We had opened the office in Sydney, Australia, last year. And really, the overall plan is to have indeed a geographical diversification. And with the opening of the offices, we feel we are better able to get closer to the market, be closer to the people, increasing our networks, the market information, closer to the assets that we hold or that we looking to buy. So all in all, we believe that strengthens our position in diversifying our holdings internationally.
Okay, good. Jim, I just want to pick up with you. Just, I mean, we mentioned there. Amy mentioned some of the sectors. In Canada, Rick also talking about positive sides in terms of the residential. What are you seeing in other sectors? I mean, obviously in Europe, there's been a big focus on logistics. What are you seeing there?
Yeah, the logistics sector globally, everybody understands that online shopping creates back-end demand for goods to be stored someplace and to be shipped to someplace else. That's an easy thing for investors to understand. Everybody wants to jump in on that. Challenge is that if everybody sees it, it's, everybody chasing it. It's the one sector where there's some favorable price trend growth, so that's something that everybody's trying to catch on to. The areas where there's challenges, it's the stuff that because we just don't have the same kind of social safety net in the United States that is seen in elsewhere in the developed world. Consumer activity has really shifted. Hotel, that's the one sector that is fading the most, both out of fears and out of income challenges. Households don't have as much income to spend. So deal activity is at frightfully low levels. Although honestly, the hotel sector was running into trouble even before COVID. Last year, I was in Korea, and everybody and their brother wanted to ask me about a hotel bankruptcy in Times Square, because one Korean investor had held the note on that building, and it's a small community in Seoul, so everybody wanted to know about that other person. But the hotel sector was facing trouble just from competition from like Airbnb and excessive construction. Then if you move up the ladder in terms of doing better, retail is next to worst. Consumers are not going to the mall like in the past. Many of these buildings, we were overbuilt on retail anyway in the United States. We had way too much floor space relative to the spending power, so it was ripe to be disintermediated by something like online shopping. And COVID has accelerated the tendency towards online shopping. A lot of these buildings are just going to have an appointment with a bulldozer in the future. So that's the other one where there's a lot of challenges. The other thing that really happens is people talking about regional issues. Do I focus on urban areas or suburban areas? There has been an acceleration of households moving to the suburbs. Personally, I don't think that's the case of people fleeing cities. It's mostly a demographic wave that was going to happen anyway. People always talk about the millennial generation. They were starting to get to an age in their 30s or so where they're not living above a tattoo parlor, acting like hipsters anymore. They're settling down, having starting families, having kids. That's the traditional pattern in the United States where people move to the suburbs. They have a yard for the kid to run around in. It's just all that's being accelerated at once. So there's some people fearful of urban areas. Personally, I think that there's an opportunity in that to kind of jump into urban areas just as things end. Because it's not like after the baby boomers demographic shifted and you had to hollowing out of cities for a bit. There will be a large cohort of people coming into cities once things are done from the generation that comes after millennials. So I think some apartment stuff in urban areas People are a bit fearful of urban stuff right now, but I think that there's benefits there longer term.
That's interesting, and obviously it's time for me to look for apartments above tattoo shops, Jim. I can see and grow a hipster beard. That's obviously where I need to be. Just Rick. I mean, when we were at Expo Real, I mean, I remember us talking about the multifamily in the US, and also how European markets were beginning to develop, but that it was still relatively early stage. So I just wondered how you see the European markets now, from your perspective in the US. Does it seem as though it's now beginning to develop more of a multifamily model? What's your view on the European market as it stands?
Well, clearly there's been growth and maturity when we first met a number of years ago, and we've been dabbling in Europe for many years and spending time trying to understand the markets, either as a consultant or just out of general business interest. There's more stock, there's more product. When you look around markets like the UK, certainly the Spain markets, the Nordics, there's been development, there's been redevelopment. It has grown. It's not nearly on the scale of maturity as the U.S. markets, which we understand. We have a very robust, very established market, both in terms of housing stock, but also in terms of just the operational capability. So it has changed dramatically. It's become much more of a core business versus what it was even 3 or 4 or 5 years ago. Having said that, I still think there's a lot of room, there's a lot of opportunity. A significant amount of capital wants to invest and grow the multifamily piece throughout the European markets, pan-European strategies. We have lots of conversations with existing clients and partners about that. The trick is it's hard to actually deploy the capital. There's not much stock, there's not many opportunities, and some are going the development route, as you've seen. There's some redevelopment that's happening, but it's coming, for sure it's coming. And we think that'll continue both out of investor demand, but also just out of lifestyle demand as cultural norms shift to become much more normal to live in a purpose-built rental apartment has become much more an acceptable way of living in the European markets, whereas it wasn't not that many years ago.
No, I think that's interesting. Amy, I just wanted to pick up with you one of the things that Jim was talking about, and has been a consistent theme really, which is the sort of acceleration of existing trends. And how are you seeing that from your perspective in North America?
Wow, that's a really great question. I certainly think that is absolutely the case. Before I get there, I want to just add on to Rick's comment, because we have a fairly substantial European apartment portfolio as well as a North American one, and we had better rent collections in Europe than we did in North America, and we had excellent rent collections and velocity of leasing, where we had some holes in our portfolio from the corporate units rolling out once COVID started. So I think that the big distinction, and the thing that's difficult for North American investors to get their heads around when they go to Europe for residential, is the rent control structure. And you'll find that in Canada as well, that's something that U.S. investors are really not expecting, because it's just not the norm outside of very, very select few coastal markets in the States. So in terms of those trends, one example would be co-working, and people expected co-working to come to an abrupt halt. And in fact, our co-working business is probably the busiest part of our office practice, because smaller tenants that really have a problem with line of sight on where their business is going to be on the other end of this pandemic are looking to co-working. They're letting their leases go and they're moving into co-working operations. And there's some enterprise customers doing that as well, just because the business model acceleration that you just asked me about is absolutely happening. It's not just e-commerce. Digital transactions related to banking and the whole finance industry, and even how we operate real estate, are all changing, and people are rethinking how their overall occupancy solution can get closer to their customers, can get closer to their workforce. And I agree with Jim that I don't think that this is going to signal the end of cities. Cities have all kinds of other attributes that are unreplaceable, like the depth and quality and range of the talent pool and the whole vibe that encourages creative exploration and creates opportunities for people. It's just in a pause until we can get the pandemic under control in the States. So those are two examples. The digital revolution and in general, automation as a solution to distortion or shortcomings in the labor market. And I also think that onshoring, there was a big push, obviously, by the current U.S. president to try and bring jobs back to the United States. I'm not sure that the tools that he's deployed have been very effective, but I think that that has long been a proposition of the Democratic Party. So I think we'll see that again. That's going to benefit industrial again. Here in Canada, there's an effort to do that as well, and the industrial vacancy rates are so low. I mean, they are really low, like in the country, around 1% or a little less. That we actually, my favorite anecdote from the pandemic is that Walmart converted 9 of its Toronto stores into fulfillment centers because they just could not find industrial space, period. So we're hearing about a lot of innovations to address that. People who are building condo towers are asking to convert the first floor residential to last mile fulfillment. And we're just seeing some real innovation going on because land use changes are slow in the Canadian market. The US market, for the most part, there's some exceptions, like if you're trying to do business in California, but for the most part, you can throw buildings up pretty fast in the US market. So you get a closer correlation of supply and demand. So we're seeing wild rent increases in the industrial market up here. There's most provinces have restrictions on hiking apartment rents so that the very, very low vacancies aren't translating into kicking people out the door. But those are some of the trends that I think have accelerated and have been brought forward a couple of years.
Great. Yeah, I mean, it's really interesting. I mean, that mirrors quite a lot of the things that were in the logistics discussion that we had earlier today, especially about that reuse element. But I just wanted to pick up with you. I mean, you're obviously Bouwinvest, well known for investing in European markets. What are you looking for in terms of North American markets? Are you already active in Canada? And what types of product are you looking for? Are you looking for residential? Is it winning cities? What's the investment strategy?
Yeah, no, a lot of ground to cover there, and also wanted to check back in with some of the comments made by Rick and Amy and Jim. I think just as maybe the multifamily concept is making its way over into Europe, the other way around. Amy spoke about rent controls. We see a big wave, maybe somewhat kickstarted by Europeans in affordability, and we believe sustainability is driving value long term. We are investing for our beneficiaries on a long-term basis, and hence we translate that into affordability, particularly in the residential sector. So we have made a recent commitment in affordable housing in the US, and are strong believers in that strategy. Picking up on Jim's comment on suburbanization already happening and millennials moving out of cities, I think also there's a level of affordability in build-to-rent single-family rentals that could take advantage of this trend, where millennials loaded with student debt are probably unable to meet the demands for making a down payment to buy a home in suburban areas. So those are sort of the things that we are thinking about in terms of the living sector.
I think it's interesting to see how the living sector has really moved forward. I mean, again, in the discussions that I'd had with Rick before, there were discussions around, student housing, but also senior living, healthcare, those aspects that are all now really beginning to grow. Senior housing and healthcare beginning to come through, especially student housing, very big in the UK and growing across Europe, and I think that's really interesting to see. I just wanted to pick up with you, Jim, in terms of the capital. Is Bert alone in terms of European capital coming to the US?
I hope so.
What are you beginning to see? Has that? I mean, obviously, in terms of Bouwinvest, irrespective of the virus, they've just continued with their plan. Are you seeing more of that, or are you seeing a pause, Jim?
Well, I mean, there is a pause only in the sense of people can't, come here, visit, kick the tires. That said, the top countries for investing into the United States, Germany is back. It had been one of the leading countries in the past in terms of investors looking at assets in the United States. European capital in general had pulled back for a bit. It just, the cost to hedge was so ruinous that it just didn't make sense to be buying assets in the United States when an equivalent property in Europe, equivalent in terms of yield, made better sense. Why go through that hassle if the cost to hedge is so great? With interest rates coming down in the United States, they're not down as much as they are in Europe, but it's still down enough where the cost to hedge has not been as ruinous as before. And so, the fact that the German investors have moved up to the number 2 position behind Canada, I think you will see more European investors looking at the United States in the sense that they were kind of blocked out for a while because of those hedging costs. I don't think anybody's going to displace Canada, though. It's just there are neighbors next door. You hear the story of just how tight the capital markets are there, with everybody kind of trading assets back and forth between a bunch of big pension funds. So they have to buy stuff down in the United States.
Okay, good. And Rick, just in terms of the trends that you're seeing, maybe the market trends within the sort of residential side, because I also remember you mentioning before about doggy daycare and those kinds of things, which at the time I remember everybody else on the panel and in the audience laughing loudly. But now nobody's laughing here because there's a huge, there's a huge demand for pets and those kinds of things in the residential. So you were definitely ahead of the time here and giving us information in Europe. But so what are the trends that you're seeing at the moment, Rick?
Well, certainly amenity-laden developments and properties. There's always been a bit of a race for the coolest, the latest amenity package. Technology is playing a significant role in what we're doing from an operational standpoint in terms of, especially in this environment, ease of access, contactless entry, the ability to have packages accepted without people touching your packages, so to say. There's a lot of things that are coming out of COVID. Frankly, from the technology standpoint, the whole COVID-related environment, I would say, has significantly accelerated the acceptance of technology. We're seeing that in a much more rapid pace. Technological advantages, and then the last thing I would mention, going back to the urban-suburban conversation earlier, is we still see strength in our urban markets. The suburban markets have seen more development lately. There was a push of urban core development product. I happen to live in a high-rise urban environment in downtown Dallas, and I can see 5 buildings being built around from my windows that are very high-end urban-type buildings. But yet we also see in most markets around the U.S., we're seeing that suburban product being built and accepted. So there's a strong correlation between the two. It's not for everybody, one or the other, but I still think both of them will continue to be viable markets going forward.
Okay, good. And Amy, just in terms of what would be viewed maybe as some of the more niche sectors like co-living you mentioned before, co-working, less, I guess, but also senior housing, healthcare, those sorts of more alternative sectors. Do you see the sort of investment, I suppose, sentiment moving again, being accelerated a little bit towards those sectors? What's your sense of that?
Well, I think the question that you asked earlier is right on point, which is to the extent that these trends were manifesting themselves in the last few years, they have been accelerated. It happens that we just, day before yesterday, I delivered the annual tenant sentiment survey to the Canadian Apartment Summit, and that should be posted on Informa's website probably in another week, and I'll put it on mine as well if people want to hear the full spectrum. The point here being that there's a difference between immediate shifts in the market and more medium-term shifts in the market, and I do think there's been an acceleration of those trends, but to pick up where Rick left off specifically, we moved from 45% of renters saying they would not rent an apartment if it didn't have direct access to outdoor space like a patio or at least a common tenant patio feature, to 95%. Now that's the sort of thing you would expect when people are locked in their homes. We saw an increase from about 15% of people saying that they really need their apartment to provide locker storage for delivery of e-commerce facilities. That went to 65%. We saw a significant short-term, maybe long-term durable shift in how people want to access their buildings and their units. To fobs and more touch-free types of elements. Saw a shift in the relative importance of natural light versus soundproof walls. Soundproof walls topped natural light. Natural light got bumped down about 5 things. So, I think the challenge for the investment community is teasing out what of those trends are a reaction to COVID and what of those trends will be durable as we move into the future. And part of the benefit of doing this tenant analysis at the depth we do, it's pan-Canadian, and we're in our 5th year. We have year-to-year comparisons over a good profile of time, but we also ask the tenants how much they'd be willing to pay for these extra amenities. And the shift really in this year, which I think was the biggest surprise, is that the take-up of programming, things like cooking classes and yoga classes at their buildings went from about 30% to 65%. And maybe that's because people were home more, but I also think it is, there is a bit of a mentality about bringing your community closer to your home and spending less time on commuting and thinking more about how much you can get for your dollar where you are. So people who were used to working out at the gym at their office, obviously that option has been limited in the last 6 months, and they're saying that one of the key things that will drive a decision to rent an apartment, should they move in the next year or two, is that the building has at least some kind of limited capacity gym. The better, the bigger, the better, the more amenities, great. But the affordability stuff starts kicking in here. What they're really willing to pay for that is quite a bit for the minimum amount of access, and at the higher income levels, more for more.
Okay, interesting. Again, this is, one of the things that's come up in a lot of the discussions is the sort of ESG side of things, wellness, and that picks up that, I think, Amy, as well. And Bert, you also mentioned that in terms of almost kind of impact investing to a certain degree as part of ESG with the strategy there. I guess more broadly, how is ESG perceived in the US markets? Is it the same as it is in European markets? What's the view on it? I mean, it appears to have been accelerated hugely here in Europe for certain, and I just wonder what the position is in North America for anybody.
Yeah, maybe I can start with that. I think overall, I think in general in the capital markets, you certainly see a big pickup in sustainable investment strategies after some of the leading asset management and investment management houses really endorsed it. Probably also driven by some of the big institutional investors like ourselves, but also many others. I think now the ESG or sustainability is more coming to the forefront also in the US. If you want to translate that into real estate markets, I think there's still quite a long way to go. I think GRASP has made quite a big push, and also is now really putting themselves on the map as one of the key, performance measurement tools for really making ESG more practically implementable. But I think there's still a long way to go in terms of the Paris Accord, not universally adopted in the US, and those sort of things still hamper true progress in that respect.
And I wonder what just in terms of the market, what's the position with financing, availability of financing, and also are there concerns, challenges ahead? Do we think in terms of the potential economic recession that everybody's expecting to be a global recession, and based around that and the impact that may have on the real estate side? Whoever wants to pick that up.
I might just comment from the residential standpoint.
Yeah.
There's significant availability of debt for multifamily projects, whether it's a new build or existing acquisitions. The agencies that provide most of that debt instrument are alive and well, although going through some restructuring. And then I think the other piece of that is just the equity. The equity is very much in line with multifamily and on the industrial side, and those are the two darlings and remain to be darlings in the U.S. markets. So there's significant capital that's available both on the debt and the equity side to get things done, albeit back to Jim's earlier comment, there certainly has been slower this year, as you would expect. But as I commented earlier, I think it's picking up and will continue to pick up through the balance of the year and into next year.
Well, piling on those two comments, we've seen a hockey stick increase in the amount of green bond issuances this year. And so the market receptivity to that has been excellent. And we'd be committing neglect to not mention that probably the biggest shift of all on that front this year has been the increased focus on the S in ESG. And you asked me earlier about senior and student housing and co-living. Now, co-living is getting adopted faster in Europe than it is in North America. There's just sort of this independent spirit culture, which is proving to be of mixed results through this piece. But in any event, that's slower. But senior living and the concentration of COVID in seniors facilities has been a real crisis for that sector. And, in general, in the United States, where the healthcare debate has just been circling fairly counterproductively for the last decade, the fact that the senior homes were not able to protect their residents, and they weren't in Canada either, I think is a real black eye for the sector. And we've seen a high percentage of those CEOs replaced, and they've done some hiring on the technical side to see what they can do with technology. And I think that that sector will be hit because people are not going to move into facilities that were unable to protect their residents. So we are seeing an increase. I agree with Bert completely that we're seeing an increase in requests from our pensions about impact-focused funds, because they don't have the resources internally to do that research and figure out how to support those sectors. And a lot of that is domestically focused because they, we've ripped the Band-Aid off the racial inequality picture and the income inequality effects. And so people are looking for innovative solutions that will respond to the communities in which their beneficiaries live.
Okay, good. Now we've conveniently got sort of 4 minutes left, which means it's a minute each. Just to tell us what your view is on the opportunities in your markets. So let's start with you, Rick. Where do you see the sort of opportunity at the moment in North American markets?
As I mentioned before, in terms of the urban-suburban debate, which it's very much a debate these days, I think there's opportunity. There's a lot of new projects that are committed to. They're under construction. They either are leasing up or will be leasing up, and we expect those lease ups to be slow and somewhat challenging. We're involved in a number of these around the country. And I think from an investment standpoint, there's going to be opportunities in that. The equity will be is nervous about what the short-term future looks like. There will be some discounts in terms of being able to come in and acquire those assets, and they're, for the most part, going to be trophy long-term hold assets. At the same time, there's secondary markets that tend to be suburban. You think of markets in the U.S. like a Kansas City, like a Reno, Nevada, which is usually not on people's lists, like a Nashville, Charlotte. Some would argue that those aren't necessarily secondary markets, but compared to the Sexy Six, they certainly are. And we're seeing a lot of investment interest in that, and the job story in those markets is phenomenal. So there's still a demand for housing, and we see investment dollars and institutional capital looking in those markets. Interesting phenomena, which is a market we had really not seen a lot of institutional capital flow into. Las Vegas has mostly been private, net worth, family office type groups. The institutional groups are now hovering around that market, trying to make acquisitions because of the long-term viability of that market. So I think there's opportunities, and you have to look at them a little bit differently. And to Amy's points earlier, we have to be creative in terms of how we look at short-term, medium-term, longer-term trends.
Great, thanks. Bert, what's your view?
I think I've alluded to the single-family rental attraction, and like Rick was saying, we will be focusing on the Sunbelt markets, where we see particularly a lot of population growth and positive macroeconomic drivers. Besides that, we are overweight residential and industrial in our portfolio as it is. We will continue to maintain that weighting, and going forward, we'll be looking to add more alternatives. And we currently particularly seeing with COVID acceleration of the trends into technology, and we translate that into demand for data centers, and with the very much the increased funding in research for healthcare, we translate that into an interest and the attractiveness of the life science sector.
Yeah, that's interesting. The life science sector has certainly been seeing some growth here in Europe. Jim, what's your view?
Yeah, I think the real opportunity is in fear. It's about going into things where there are dislocations. Every recession is different. There's different drivers, different economic challenges, but there's a constant in that there's people involved. And the people have always tended to be a little too fearful in the middle of a recession about the property sectors that are bearing the brunt of any current economic activity. So after the 9/11 downturn, the hotel sector, nobody wanted into it because travel had been shutting down for a bit and occupancies were down. But it rebounded very strongly, and it beat everything else in the NCREIF index in 2004, 2005. So running into where everybody else is becoming too fearful, I think once we have some sort of clarity around the disease and what happens next, I think that's the best opportunity. That's going to be hotel. That's going to be apartments in urban areas where people are too fearful, I think, at times. There's some offices in urban areas. And they're coming in and they're riding a bit of the rebound in those areas.
Great, thank you. Amy?
Okay, so we are focusing on takeover opportunities in distressed retail because there's quite a number of managers who are quite generic, who really clearly don't have the skills to deal with the holes in their portfolio. And what do you do with tenants that just want to roll on to percentage rents indefinitely? And how do you make those decisions? And because of the platform and analytical tools we have, we're able to really rifle shot those particular situations. Next, we're focused on small bay industrial because to Jim's point, that's the smaller tenants, there's a lot of consolidation going on, but last mile distribution is a real growing area, and those infill smaller facilities, the rents are growing, particularly in the US, at 7 to 12% compounded annually. So that feels to us like very serious wind in your sails. And most investors really aren't in a position to manage a highly multi-tenanted industrial portfolio. It really requires a lot of boots on the ground and a lot of thinking. And then lastly, we have rolled out a life sciences program. I completely agree with Bert, especially in North America, where there's a strong inclination to fund research and development through the university structure. We're partnering with a number of hospitals and universities to build new life sciences campuses. So if you want to talk about any of those strategies, pick up the phone.
That's great.
Perfect.
Super. Thanks very much. Thank you, Amy. Thanks, Jim. Thanks, Rick. Thank you, Bert. Really interesting